Are you tired of watching others make money in the stock market while you're stuck on the sidelines? Most beginners lose money because they fall into the same 3 traps. If you're making even one of these mistakes, it could cost you thousands in the long run. The stock market has created more millionaires than any other investment, but only for those who know how to play the game the right way. Did you know that 70% of beginner investors panic sell during market dips? Imagine if Warren Buffett did that, he wouldn't be a billionaire today. Stick around, because in the next few minutes, I'm going to show you the best beginner-friendly investing strategies that can help you build wealth in 2025, without stress, confusion, or risking everything. And at the end of this video, I'll reveal the #1 investing mistake that's keeping most beginners broke, so don't miss it. Instead of dumping all your money into the market at once, spread it out over time. This way, you lower risk and avoid bad timing. Let's say you have $6,000 to invest. Instead of going all in at once, you invest $500 every month for a year. This way you buy at highs and lows, averaging your cost and reducing risk. Removes emotions, no panic buying or selling, avoids bad timing. You don't have to worry about buying at market peaks. Takes advantage of dips. Buying consistently means you get stocks at discounts. Studies show dollar cost averaging outperforms market timing 80% of the time. Even investing pros struggle to time the market perfectly. Ever wondered why billionaires keep investing, even in crashes? They know that consistency beats luck. Do you already use DCA? Type yes or no in the comments. Let's see how many smart investors we have here. Think of it like a team of all-star companies. Instead of betting on one stock, you invest in a basket of top performers like Apple, Google, and Amazon. Low risk, less chance of losing everything. Diversified, you own a piece of hundreds of companies. Strong returns. The stock market historically trends upward. The S&P 500 has averaged 10% yearly returns for decades. That means even a small, consistent investment can turn into 6 or 7 figures over time. The world's #1 investor, Warren Buffett, advises everyday investors to choose index funds over stock picking. Even hedge funds struggle to beat them long-term. Imagine putting in $100 a month into an index fund and waking up years later with a fortune. Sounds crazy? That's exactly how millionaires are made. Drop AI in the comments if you're considering index funds this year. Imagine owning a stock that pays you money just for holding it. That's exactly what dividends do. Companies share their profits with investors. Earn consistent cash flow while your portfolio grows. Less risk than growth stocks, perfect for stability. Reinvesting dividends supercharges your wealth over time. Companies like Coca-Cola and Microsoft have been paying dividends for decades, even during recessions. Reinvest your dividends to harness the power of compounding. Over time, your earnings will start earning their own earnings. Would you rather have a high-growth stock that could skyrocket, or a steady income stream that pays you year after year? The right answer might surprise you. Drop A in the comments if you'd love to get paid just for holding stocks. Think of an ETF, exchange-traded fund, as a basket of investments. It can hold stocks, bonds, or even commodities like gold. Instead of picking individual stocks, you get a diversified portfolio in one easy investment. Lower risk than individual stocks because you're investing in multiple assets. Higher growth potential than bonds since ETFs include strong companies. Easy to invest in, just like buying a stock. Let's say you believe in AI but don't want to risk everything on one company. An AI-focused ETF gives you exposure to top tech giants like Nvidia, Tesla, and Microsoft, all in one investment. Some ETFs pay dividends, meaning you get passive income while your investment grows. Would you rather own one stock that could crash or a diversified ETF that spreads out the risk? Smart investors already know the answer. Would you invest in an AI ETF or stick to individual stocks? Let me know in the comments. Imagine owning a piece of rental property without having to buy a house deal with tenants or take out a massive loan. Real estate crowdfunding lets you invest in properties with as little as $100 through online platforms. No need for huge capital. Start small and scale up. No landlord headaches. Professionals manage the properties for you. Diversify your investments. Own a share in multiple properties instead of betting on one. Platforms like Fundrise and CrowdStreet allow everyday investors to invest in real estate passively, just like how the wealthy build long-term wealth through property. Would you rather invest in a rental property that requires maintenance or a hands-off real estate fund that pays you without the hassle? Smart investors already know, stocks or real estate, which one do you prefer? Drop your answer in the comments below. Dollar cost averaging DCA, invest small amounts consistently and avoid bad timing. Index funds, low risk, high return and Warren Buffett approved. Dividend stocks, earn passive income while your portfolio grows. ETFs, diversify easily with stocks, bonds or AI-focused funds. Real estate crowdfunding, own property without buying a house. Start small, stay consistent and let time and compounding do the heavy lifting. Wealth building is a marathon, not a sprint. Want to build a $100,000 portfolio step by step? Click the next video now. Which strategy will you try first? Drop a comment below. And if you found this helpful, like and subscribe for more investing tips.